The earnings season kicks off. The banks are starting to give us information about what is happening with the U.S. economy, the global economy, and their businesses. What's the takeaway, and what's the takeaway from what we've got thus far for the rest of the earnings season?
Well, thanks for having me as always. And, it's an interesting day as usual. Look, I think that the banks always kick things off. We always spend a lot of time focusing on the banks. And so far, I think what we're hearing from the banks about the health of the U.S. consumer is something, frankly, that I'm also hearing from consumer companies so far, which is that the sort of rumors of the death of the consumer seem to be greatly exaggerated at this point. And that's not to say that there aren't real risks out there that we need to take seriously. But Guy, one client after another keeps asking me why the market is up versus the lows in March. And I keep telling people because I don't think the market is actually convinced yet that a recession is coming. The risks are real. The logic makes sense, but we are simply not seeing evidence of a breakdown from corporate America yet. And I think the market is correct in sort of the levels that it's at right now.
Lori, I'm very curious about what a lot of these companies are going to be doing with the enormous amount of cash on their balance sheets, not just the banks, but you have tech, for example, and of course, some of these other sectors that perhaps their stock has been under pressure in these last 2 years relative to some of these big tech flyers, but they also have a lot of cash on their balance sheets. Talk to us a little bit about how they're going to deploy that cash in an inflationary environment.
Well, look, I think that's a great question, Kriti. And we actually have been using the Bloomberg Transcript Analyzer tool. I'm going to give you guys a little bit of a plug to see what companies have been talking about in regards to cash deployment in terms of things like buybacks, dividends, M&A, CapEx, et cetera. And what we've noticed is that coming into this reporting season, discussion about buybacks is on the upswing, discussion about dividends is on the upswing. We're also seeing that for CapEx. And I think that CapEx expanding capacity is one way that companies are trying to battle inflation. Nearshoring is a theme we've been starting to read about a bit more. At the same time, though, we're seeing fewer mentions of M&A, which is something investors always ask me about. Now, we're not seeing a big upswing in comments about debt paydown right now, but I wouldn't worry about that because we actually saw a lot of conversation about debt paydown in 2021, which is telling me that companies knew the Fed was starting to move and were getting ready for it by cleaning up their balance sheets.
What are companies trying to communicate by focusing on dividends and buybacks at this point? What are they trying to tell their investors about the types of companies they are? What do you think the message is?
Well, look, I think that they are trying to emphasize that they are continuing to reward shareholders for investing in their companies. And on the dividend side specifically, we know that that is something a lot of retail investors, I'm thinking more of kind of the high net worth crowd as opposed to sort of the Reddit crowd. But that is something that retail investors typically do look to U.S. equities for. So I think they're trying to send a reassuring tone.
Sorry, Lori, is that an inflationary hedge? Are they looking for are they basically trying to communicate to their investors that they are an inflation hedge?
I think so. And look, we do see that borne out over time. If you look at positioning in U.S. equities relative to cash and bonds, it does tend to track CPI over time. So we do know that that's borne out in terms of behavior. And I think companies are trying to say, look, we're able to manage through these inflation pressures and still reward shareholders at the same time. So it's really, at the end of the day, trying to send a message of confidence.
Well, speaking of a message of confidence, I'm curious about the recession risk because we talk a lot about this, that perhaps the United States, Europe more so, but the United States could see a recession down the road. But it doesn't seem like a lot of companies are necessarily that concerned about it from what I'm understanding. They're talking about a slowdown in growth. I guess the bigger question is, does that mean that they're going to start trying to pass on more of those costs to consumers and foresee that those consumers can't digest it? Talk to us a little bit about the margins picture.
So, if we just start with margins, we know that companies have been talking a lot about margin pressures in recent quarter, really for the past year and a half or so. But the margins are far outperforming the commentary that we've seen because we are, again, seeing companies really emphasizing, hey, we've got all these pressures out there, but we're still able to manage through them. Pricing is one way they are managing through. And so we've actually seen a surge in commentary on pricing in recent call transcripts, earnings, and otherwise. And what we're noticing is that analysts on the sell side are really pushing companies to say, is the pricing strategy working? Are you getting pushback? And for the most part, companies are saying that they're still able to pass those prices through. And look, I think the demand discussion is one that's of utmost importance. We are generally seeing characterizations of demand as quite strong, not quite as strong as they were a few quarters ago, but still very, very strong. And I think as long as companies are still saying, hey, look, the demand is incredibly robust, the underlying appetite to spend, both corporates and consumers, is still robust, it's very, very hard for investors to say, hey, look, there's evidence of recession out there. It's this smells like something different if you really look at what the companies are talking about.
Given that, given what you're saying about the recession, given what you're saying about what companies are saying, do you think the Fed's going to be comfortable with that? There is this fear that the Fed is looking at all of this and saying we're not getting the reaction, both from the corporate sector and also from the markets, that we need to see in order to drag down inflation back to levels that we're comfortable with, say sub 3%. Do you think the Fed is going to look at what is happening here with corporate America, what it's doing in terms of wages, what it's doing in terms of margins, and say, you know what, we need to go harder here?
Well, look, I'm going to leave the sort of Fed calls to my esteemed economist, Tom Porcelli, but I was talking to him about this issue recently. And one of the things he told me was, he said, look, as we get later on in the year, if some of the data starts to look a little bit squishy, and squishy, was his quote, not mine. But he said, I do think the Fed is going to sort of acknowledge that, and I will say we did an investor survey recently, Guy, where we asked people about their faith in the Fed, and it's very, very low among investors right now. A big contingent of people who think they're going to tighten and go too far and impinge on growth. And then there's another decent contingent who think they're going to continue to let inflation go out of control. I would say maybe I have a little bit more faith in the Fed than either of those camps. And like Tom said, we'll continue to sort of look at the whole picture as the year progresses.